Passive Pockets is presented by Equity Trust.
Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Chris Lopez, and today I'm joined by Peter Kim, a physician turned investor turned GP, who is the co-founder of Ascent Equity Group, a community that helps busy medical professionals vet and invest in private real estate deals. So in today's episode, we're going to unpack the moment that pushed Peter to change careers, what he is learning in today's tough multifamily market, what investments he has in the works right now, and how he's positioning himself to take advantage of upcoming opportunities. All right, let's jump into it. Peter, I am excited to have you on the podcast. Thanks for joining us, man.
Hey, I'm excited to be here. This is going to be a lot of fun.
Let's jump into it and kind of just rewind the clock, because I know from your story, you're a physician turned LP turned GP, but many years ago, you're on the successful track of becoming a partner, and then you had a pretty abrupt wake-up call when it came to scheduling and expectations.
Yeah, I mean, I think that like most physicians or people who are on some of this whole professional train, you just think that's going to be your whole career. Like you work everything, like everything lines up for that moment. And probably like a lot of people listening to this, they thought like that they were going to be set when they got to a certain point. And that was my path when I thought, hey, if I can become just a doctor, I can just get out there, get my job, and I'm good to go for the rest of my life. What happened was a little bit different, and you kind of alluded to it. But when I became a partner, by the way, my background is I'm an anesthesiologist. OB anesthesiologist for people, if I get a little more specific, help with epidural, spinal, C-sections, babies, all the good stuff. But when I became a partner, what was promised to me didn't happen. They had promised me equitable shifts, a bump in income, a better schedule, and it just never happened. And it's like they said, I know we said it, but things had changed. And of course, like anybody else, like you get like the rug pulled out under you and you're like, wait a minute. This was not what it was supposed to happen. I had this whole path, just work hard and I was going to get there. And then all of a sudden I was kind of in, I didn't know what to do. I was kind of in limbo and I was like, how do I figure things out from here? Like my whole worldview had changed. And that's kind of what started me along this whole path.
Why did you get into the world of real estate? Like you had a pain point. Why real estate?
Well, again, I didn't know what to do. I was like, look, if somebody controls my future, like in medicine like this, I'm like, I've got to figure something else out. Now, honestly, I didn't even know what that was. I barely had any idea of what it was going out in the real world besides medicine. And so I just started talking to other doctors and really being an anesthesiologist, like actually for a lot of people who don't know, it puts you in a great position to talk to a lot of other doctors. Like you just meet other surgeons, you meet other specialists, because you're always going around and helping and supporting and being in different roles. And I remember there were like some doctors, I was like, man, they look pretty happy. They seem to live pretty good lives. They're talking about the vacation they went on with their kids. Then you see the other doctors who have like their heads down, nose down, and they're just like, into their work. But I was like, okay, these happy doctors must have figured something out. So I went to them and I would just talk to them and be like, hey, just curious, like, how are you able to not only work and enjoy your work, but also be able to have a life outside of work? Like, what is it? And I just got curious and I started asking people. And after talking to enough people, I started noticing a pattern that the ones that really seemed to have a little bit more control over their lives had figured out how to create streams of income outside of medicine, outside of being a doctor. And so I was like, oh, well, like what? Like, what are you doing? And it just turned out that most of them were doing real estate. I'm like, real estate investing? I never even thought about that. And so I just started digging in, trying to figure out as much as I could from them. I started jumping into BiggerPockets podcast. I mean, I started going deep to try to figure out, all right, if this has worked for other people, like there must be something to this. And how can I make that work for me?
All right. So what was your first real estate deal?
I probably like a lot of people there. I read, I listened, I thought about it for like the longest time. And then finally I was like, okay, well, nothing's changing. So I better get in and dip my feet in just to learn. And so I was at a real estate conference and I heard about something called crowdfunding at that time. That was brand new, where you could go in for low minimums. And so that very first investment that I made was in a crowdfunded deal for $5,000. And it was at a point where, and trust me, I was extremely nervous, so scared to put that first $5,000 in. But I felt like, all right, well, like I got to do something. Obviously, it may not change my life, but at least it'll get me started. And I always tell the story of how I put that $5,000 in. It was the scariest moment for me, clicking that button. About a month later, I got my first distribution, and it was $47. And I remember going nuts. And I called my wife. I told her, I was like, you won't believe it. I made some money in real estate. And again, I knew $47 wasn't going to change my life. I think we just went out to dinner or something, but I just saw the potential. And so after that, I went nuts. I just dove in as far as I could.
Talk about your journey as an investor and then how you kind of scaled up as an LP, like, the deals you look for, the due diligence, just like that journey, right? Because we all have that, hey, the first check, it is the scariest to write. And then allow us, hey, we end up writing more checks, right? So like, what was that journey like?
Well, I think in my world, like you're taught to kind of be safe first, right? There's like lives on the line. And so you have to be really measured. It's always this risk benefit ratio that we always talk about in medicine. And I think that probably applies to everything, right? In life for anybody, like what's the risk and what's the benefit? And is it worth it? And have you mitigated the risk enough and to take the benefit and take the leap? And so when it comes to investing, I think a lot of high income professionals probably think the same way. Like it's very risky. It's scary. I don't know. I'm not sure. I could just go to work and make some extra money. And so that was a challenge for me in the beginning. So I made that $5,000 investment. Then the next one I did was jump into a $25,000 syndication. And then after that, I bought my own first apartment building. And then I started kind of just investing even more passively. And I will tell you, like in the beginning, I didn't really know much. You can read. There weren't a lot of the great resources around syndications or passive investing. There was a lot around active real estate investing. I felt like a lot of the books were, catering to people who want to do the Burr method or house hack or whatever that is, or own apartment buildings, which is great. But there wasn't a lot to the passive syndication, type investor. Which is awesome. What you guys are doing now is incredible. The people who are starting this now, they probably don't even recognize how great it is to have a resource like this in the community that you guys have built. But that didn't exist back then. And so there's maybe one book on the subject that was really in the weeds. And that book totally confused me. And so I was like, all right, well, I got to get started. And I tell people.
Wait, what book was it?
It's like the Guide to Passive Investing or something by, I think it's Sean Cook. Is the last name. And it's a great book, fantastic book, but it is really, really in the weeds. And actually, by the way, you find out later that it's written anonymously by somebody who's actually a syndicator today. He was kind of sharing the secrets and spilling it a little bit, but he went in anonymously. So great book. I'll try to get you the full title later. But I remember I went and I invested that first $25,000. And this is how naive I was. About 6 months later, I remember thinking, when am I going to make some money? And so I called the sponsor and I said, hey, when am I going to actually start seeing some returns? And they explained to me, look, we mentioned this is a value add opportunity. We're going to put some cash in. We got to rehab. We got to do some renovation. About 18 months, you're going to see your first distribution. And I was like, I didn't even know that. I didn't even know when I was going to get my returns, how it was going to look. And then, of course, that led me to think, I need to know a little bit more about this. I need to understand. And so that's when I started diving in, digging in deep, trying to really latch onto as many mentors as I could to just understand this whole process of due diligence, which again, it's not impossible to learn. It's just sometimes it just seems to be a little scattered out there. It just takes a little time.
Now, I want to hear about the why and the how going from LP. I think it was about 5 years ago, you formed your own group, the Ascent Equity Group. Like, why'd you do it? How'd you do it? And then what gave you the confidence to go out there and just do it on your own? When
I started learning about it myself and I've started kind of diving in deep. It was a good time. I'll believe, I have to admit in in real estate, the early 2000 teens, I was investing heavily in 2013, 14, 15. Obviously that was a good time in the market. Things have changed a little bit today, and I'm sure we'll talk about that later. At that time, the returns were coming in, the distributions. I even had some early exits, and I just started sharing it with my colleagues. I was like, you guys got to get into this. Like, this is a real thing. This is an opportunity to figure out, hey, can I work on my own terms? Can I work because I want to, not have to do it? Can you create enough income streams outside of medicine to be able to live how you want? And so I started telling as many people as possible. And, again, a longer story that led to me creating a blog, a podcast, courses and conferences around this whole topic, just to get the community together, to learn about this stuff. And once you kind of build that community and you build that, you start to also see, not only educate them, but you're like, what are the resources for them? And so we were educating for a while, building up this massive community. And then all of a sudden I was like, look, I'm sharing some resources, but everyone was kind of on their own. And I started thinking, okay, what would be the best thing for the community? Wouldn't it be good if we had an opportunity to invest together, to try to get a seat at the table? Because I think the problem that I felt sometimes as an LP, and maybe people feel like this too, is that there isn't always a lot of transparency. You don't know what's going on. You may hear things from on an email once in a while. Maybe you'll even get a video update or whatever that is, but you don't really know what's going on. And is somebody there truly advocating on your behalf? And so I felt like, all right, so what can we do to kind of take this vehicle that's out there and make it even better for our community? And so we started kind of coming up with an idea, started dreaming. And I got two partners of mine who are also other physicians. And we started thinking, we're like, hey, we know this is not going to be easy necessarily to create or build, but like, it'll be worth it for these reasons. And we really was, hey, if we felt like our community, again, felt like they had somebody who had their back. They got into deals with trusted people. Maybe we were able to get them access that they weren't able to get otherwise. That we knew that no matter what happened, even if there were challenges, that we would always do the right thing. Because I think that's the mark of a good sponsor is when things go wrong, that they're acting still in the best interests of the people that are with them in their community. And so putting all these things together, we just decided to, hey, let's try this out. Let's see what this looks like and partner with some of the best sponsors and operators we thought at the time. And we created something called Ascent Equity Group. And that was back in 2021, which probably people will recognize that isn't the best time to maybe have gotten started. But we believe that's part of the journey and it's gotten us to where we are today.
Totally agree with you saying, transparency, communication, but also, hey, if you're writing $1 million or $5 million check, you get different types of terms and communication than a $50,000 check, right? So the power on there. So what was the first deal that you and your partners did at Ascent?
Our first deal was a smaller deal. And I don't know, maybe probably there are people out there who are, I know there's some limited partners out there, but there are probably people who are starting to do this on a professional level, right? You become an expert and you've gotten the connections and the resources and you're like, hey, how can I help other people create a business and do this? And for us, even though we had this community, I was like, is anybody going to actually invest with us? It was a scary feeling. I'll be honest with you. And actually, the other part of it is like, there's a huge responsibility. Like, it's one thing to be like, hey, there's some great resources here. Like, do your own due diligence. And then it's another thing to say, like, invest with us. Like, you could trust us with your hard-earned capital. It's a scary thought. I'll be honest with you.
You're a fiduciary now.
Yeah, exactly. And I'm like, I can sleep well if I lose my own money. I mean, it is part of the job. But if I lose my friend's money, like, oh my gosh, it's a scary thought. And so the very first deal that we did was we actually raising a small amount of capital, like considering kind of what we do today and what the market's like. So it was a $300,000 raise into another small fund. That's what we did. It was a smaller fund into like a multifamily value add fund. And we were able to raise that capital, create the system. Part of this in the beginning is like figuring out how to make it all work. Nobody teaches you this. I think, well, there are actually people who teach you this now, but sometimes we felt like, hey, we got to figure this out on our own. It was a big challenge initially to get it going, but once you do, and you figure it out, then you're like, okay, what else can I do to help? What other opportunities are there? And you just keep going.
All right, so I'm gonna do the barbell method here. I asked about your first deal. Now I want to know about the most recent deal you did in terms like, hey, your scale, the business, and also marketing conditions are very, very different. So what was the most recent deal you guys did?
I think the most recent deal that I can remember that I want to talk about it's just because, again, it was a shorter deal, ended up only being about a year, and it exited, was actually a pref equity deal. For people who aren't always familiar with that, it's more of like kind of sits in the place between debt and your normal equity as an LP. It's kind of like they call it preferred equity, and it kind of is almost like a debt vehicle where you get paid. You can structure it however you want. But the way we structured was like a high current pay that every month you would just get paid like debt. And, that would be collateralized against the property. And so we did a pref equity deal. And in the time right now, it's kind of hot. I mean, there's a lot of opportunities because people need capital. That's been the challenge of the last couple of years, is that people, because of the way interest rates have gone, expenses have gone, your pro forma, your actual operating income has been completely off the track because of everything that's happened. And so people need injection of capital for whatever reason, whether they're trying to change their loan out, whether they need something in terms of operations to right the ship or whatever it is. So there's been a big opportunity over, especially the last few years, to bring in this pref equity and be able to get some really nice returns, and hopefully it's a win all around. And so there was a deal we did. It was a deal in the Houston area. It was more like hotel, but also retail center. And so that was, I think we raised about a little over $10 million for that deal. It was meant to be kind of a quick deal. And luckily, a lot of people got into this pretty quickly. And then over the past year, people have gotten anywhere from 12.5% to 13.5% just on the, on a monthly basis without, just on the clock. And then we gave their money back at the end of the year. So, and now they're free to take it and put it wherever they want. So that's probably the most recent deal that I can talk about. It's gone really well. And again, it's with the times. I think that for a lot of people that are out there, I know sometimes it's good to have an expertise. I get it. But sometimes there are opportunities out there. And if you understand the basic model behind how money moves around in real estate, you can figure out how to find the model that works for you during that time, because not every time is best for every single asset class for that. So that's been the challenge of the last couple of years to figure that out.
You got to navigate and roll with what the market gives us, right? None of us can make the market. We just make orange juice out of the oranges it gives us, hopefully. So before I go forward into like what you see now, like, can you talk about just like, like lessons learned from, structuring deals or investing in deals as an LP the last couple of years as the market has been this like, hard shifting time frame? Like, what have you seen? What's been tough and what have you learned?
Wow. Okay. That's a pretty loaded thing. We could probably spend a couple podcasts on this, right? I mean, again, I think it's no surprise what we've been going through for a lot of people that are listening to this, where, you can underwrite for certain things. And if you look at any good pro forma, they're going to come up with some sort of sensitivity analysis where they kind of take a couple different factors and they say, well, if the market is a little bit less or this, it falls this far, cap rates are here, or if, rents are here, then here's our expected outcome. But I don't think that people necessarily expected all of it to happen at the same time and at the degree it did. I know a lot of people that have been in this game for a while, have been through multiple, I'd say up and down cycles, have been in the game 30 years, have multi-billion-dollar portfolios who during this time just got caught. You're wondering how that happened. It's because, again, they have been doing the same underwriting and due diligence, but you always sometimes come into some really unique periods in history. And I think this whole period with having come out of COVID, what the Fed did with the federal funds rate and kind of, just propping up the market, and then inflation doing what it's doing, and then the Fed having to respond to that with rising interest rates. And then you start to see costs and expenses rise precipitously. Insurance costs for probably people there. I mean, there was one property where insurance quadrupled just pretty much overnight. And these kind of things, like, yes, you want to say that you can underwrite for all these things, but you can't always underwrite for all these things. And then a lot of these things were bought on, for a lot of people, on these short-term loans. And so these are 3-year term loans. And so it doesn't give you a lot of time. However, for a lot of us, I think we felt with some of these properties and deals, like you had a little bit more time, maybe a little bit more of a runway, and maybe you thought you could have exited in time. There are a few of our properties early on where we are of that vintage, that 21 vintage, where, we went through this whole up and down cycle. So those have been challenging, I won't lie. And we've been working our way through it, always trying to do the exact right, doing the right thing by people. But a lot of times that's created a situation where we've had to even inject some of our own capital, right, to help some of these deals and get creative and get resourceful, work with sponsors, work with lenders to help them, have them help us out in terms of kind of renegotiating some of these loans or repositioning it. And so I will tell you that from an education standpoint, obviously, like, you can't learn the lessons that we're learning right now unless you go through it. And so we're learning a ton from that. And I believe, obviously, for future investors, they'll be the beneficiary of us having learned through this. But again, we've also had to learn how to do the right thing when it's difficult, when it's challenging, to communicate well. And I hope everyone in our community, if you talk to anybody, will tell you that we don't hide. We're not going anywhere. We communicate. We jump on the phone to be able to say, hey, this is what we're working through. This is what we're doing. And I think a lot of people appreciate that. So for anyone who is struggling, maybe having some challenges with deals, I just would encourage them. This is not the time to hide. This is the time to be out there, to be transparent, to let people know how hard you're working at this, to try to do the right thing by people. And I think that's absolutely important. Then again, that's the smaller part of our portfolio, actually. And so, but it is the smaller part that it's kind of like the problem child, where you spend like most of your time and energy on it. And that's kind of where we're at with that. The good thing is the vast majority of our portfolio is doing still quite well in this time, having kind of bought after that period. And that's kind of a mix of some cash flowing deals, some value add deals, whatever that is. But again, I've learned, if anything, more during this period, is the message that I try to get out to people even more during this time is real estate's not a get rich quick thing, right? I mean, even though we say that, sometimes people want it, right? And they want the quick 2-year turnaround, 100% IRR type thing of the 20s. Like we all get kind of enamored by that. But it's a 10-year horizon thing. I mean, we got to think about as investors, like building the sustainable machine that it's going to be a 10-year thing where a couple of years of it are not going to go well. It's like diversification. You know, you're going to have that full 10 years to work through it. Real estate's going to do well. I think they've shown it again and again throughout history. If you've got time, you're going to do well. So I always try to really put that in the minds of people that, hey, when you're investing with us, when you're investing out there, think about real estate as building a basket of portfolios that will last through 10 years to do really well. And you may have some bumps along the road, but if you can stay in the game long enough, you're going to do extremely well. And it really builds that vehicle of wealth creation over time.
I want to do forward-looking stuff now, right? So we were recording this podcast, I think about 2 weeks after the Fed did their first quarter point cut in September. You've done some pref equity deals. We'll probably have a couple more rates cuts. Like, where's your crystal ball at? Like, you as an investor, you as a GP, like, what opportunities are you looking for right now? What are you underwriting? Like, where do you see the opportunity in the marketplace?
One thing I recommend to everybody is go Google, recessions and Fed pivots, like those two together. And you'll see a lot of interesting charts and patterns. You'll see that every time the Fed hits their peak and makes the pivot, a recession falls shortly afterwards. And usually that recession on average is about 10 or 11 months. So don't worry, it's not going years and years and years, but on average, it's about 10, 11 months, some way shorter, some a little longer. It's a chicken or egg thing, right? Is it because they pivot that you get a recession? I would say most likely it's the other way around. They know something's happening, right? There's weakening in the labor market. There's weakening in the economy. And so they finally figure out, hey, we got to go and try to get ahead of this. And oftentimes, I think more often than not, lately it's been a little bit too late. But I will say that if patterns reveal themselves and kind of follow their own patterns. And, these cycles happen throughout history. We're going to see recession. And I don't know what that's going to look like. I don't know how deep. Like when you look at some of the definitions for recession, some of it's just about 2 years of, dropped GDP or whatever it is. But again, I think a recession is coming. And I think we should all be prepared for that, meaning that something's going to come pretty soon as we see this Fed pivot. And so how are you going to prepare yourself for it? And everybody in our community, I'm letting them know, like, this is going to happen most likely. Again, I hope I'm wrong, but why not prepare yourself? And if there's one thing we've seen again and again, when you look at just, again, the cycle of history, is that the greatest transfer of wealth happens during recessions, happens during depressions, happens during downturns. The greatest transfer of wealth happens. That's where the maximum opportunity is. And I would love to be able to say I could time it. I don't. I mean, I can't. But if you're in that period and you ride through that period, you can have the greatest opportunity. So why not right now set yourself up to take advantage of this? Just by, number one, educating yourself, which is why people are listening to this. So kudos and congratulations to everybody listening to this. But why not start to figure out where your funds are? Where can you get access to capital? Who are the great people that you can connect with and network now, whether both as an LP or professionally, to get set up for all this? Because I promise once that recession hits, there's a lot of people right now waiting on the sideline. They're ready to go. And so are you going to be one of those people that already has everything lined up to be able to take advantage of these opportunities? I hope you are. That's kind of where our thinking is to how do we set ourselves up, because we know that time is coming. We're already starting to see a lot of it right now, but I still think there's a lot more pain to be worked through in the marketplace. There are people that are still holding on, that I'm hearing a lot about that they just can't hold on very long. And so I think you're going to see that. And we've seen some price drops in multifamily. We've seen some price drops in different areas. That's going to eventually, like I said, really work its way out. But again, on the other side of this, I think you got incredible wins that are going to be picking up this other side. I mean, we all know that for the demographic, especially if you're thinking multifamily, construction has kind of come to a halt, right? A lot of the development that's out there has already worked its way through the system. So now you're not getting additional development. We know that there's just not enough housing today. People aren't able to afford homes. Where's the demand? The demand is, oftentimes in apartments and housing. And guess what? There's a shortage already. And there'll be even a greater shortage moving forward. And so will you be ready to set up to take advantage of that, especially certain markets, like even some of the Sunbelt areas that got hit the hardest? Those, I believe, again, are the areas that are going to rebound the most. And so I think there's a ton of opportunity there for a lot of people who can just ride through this. If you're having challenges right now in your investments, even as an LP or as a professional or syndicator or sponsor, you have to last. You got to get through this. And you got to keep pushing through this because, again, it's part of the cycle. And it happens again and again. And what happens on the end of the cycle, you want to be there to take advantage of it, help other people, take advantage of it for yourself, for your investors, for your family, whatever it is.
So are you mostly looking still like the multifamily asset class? Is that the primary asset class you're looking at? And you mentioned hotel, like what asset classes are you keeping your eye on?
Yeah, I think we started a lot in multifamily because that's just what we knew. I think from a conceptual standpoint, I had invested mostly in multifamily. We've all lived in multifamily. We could understand it. And I think some of those other asset classes, when you go to things like self-storage, retail, mobile home parks, office, industrial, I just didn't have as much familiarity with it, and neither did my partners. However, through this last couple years, with multifamily having its kind of swing, we've been exposed to other opportunities. And we're seeing what some of those things look like. And we've actually had a lot of connections to different people in different space. I mean, we actually have now ventured a little bit more into hospitality. We've done a little bit of retail. And although we're not there yet, I'm just putting it out there just because sometimes you put it out and hopefully it'll happen. I actually really love the medical office space. I mean, we're a group of doctors and we understand that space more than anything. And I don't think that's going anywhere. And so there are a lot of unique opportunities. And so we're connecting with as many people in the space right now that we can in that asset class and in the other asset classes that we want to try to make that happen. I mean, that's, again, a recommendation for anyone who is thinking about, hey, can I explore other asset classes? The best way to do it is just connect with people. Just find people who are doing it the best in that space. Figure out how you can, connect with them. Figure out how you can add value to them. And oftentimes that's either through bringing capital or some connections or opportunities. And I think you'll make inroads pretty quickly. And so we've spent this time with all the turmoil that's going on to set up a lot of these connections and prepare ourselves for what's coming up ahead.
All right, last question here for you, Peter. What was the last deal you underwrote? You have to go into details. The last deal you underwrote, whether you're moving forward with it down the DD funnel or you're not. Just I'm curious. Last deal that came across your inbox.
Last deal that came across my inbox was actually it's a deal we are doing, but I mean again it's another pref equity deal. I think first of all I don't think pref equity is going to be always be there. I mean again we're in a unique window of time where pref equity makes sense, but eventually it's not going to make sense. It's another deal. It's another hospitality deal, and it's a property near San Antonio Airport, where again with an experienced operator, great value add opportunity, but the property in and of itself will do fine, even without a lot of lift on it. Again, I think during this time, I mean, if there's anything I've learned, right, is that yes, we all say, okay, we look at the risk and we all do our best to look at it. But now we're really looking at the risk. Like we are really exploring again and again and hitting it from different angles. What if all of this happens? What if this? And I think that's something this time has taught us. And it's created some humility for me and for everybody, I think, in this business. I mean, again, I've had people I've sat down with over coffee that are multi-billion-dollar. They have their names on the side of buildings and things like that. And they've said, look, this has humbled me. And I think that's not a bad thing for a lot of us. Like sometimes you think you're invincible in life or you think you're doing the best and then you learn something else. And hopefully it takes, every good entrepreneur, you talk to any of them, they've all taken their hits.
We all have some black eyes.
Yeah, they all have their black eye, but I mean, we all have scars somewhere, right? They all tell stories, but somehow, hopefully it leads us to bigger and better things. And so this deal, again, excites me because I think it's from risk standpoint, it's well mitigated. And then ultimately it's an opportunity to create some good, steady income, which I believe in this day, in this market, is a huge win. And so I think people can benefit from that and create that additional steady income and passive income that they're looking for. And so I'm excited about what's ahead.
Peter, thank you so much for coming on the podcast. It was fun chatting with you. So just thank you so much.
Awesome. I appreciate you having me. That was fun.
So we had a great discussion with Peter on today's podcast. We got to talk about lessons learned from the market, talk about some pref equity deals, and also what Peter is doing going forward to take advantage of opportunities coming down the pipeline. So if this show helped you sharpen your own portfolio, subscribe and join the conversations at PassivePockets.com for due diligence tools, sponsor evaluations, and real investor case studies. We will see you in next week's episode. As always, happy investing.